What's going on, investors? AK from Fallible here. Now, the billionaire hedge fund manager and market wizard Stanley Druckenmiller, when talking about the Fed, once said, and I'm paraphrasing here, that when the economy reaches a certain level of acceleration, the Fed is no longer with you. Instead of trying to get the economy moving, they act like central bankers again and start worrying about things like inflation and the economy getting too hot. So they try to cool things off by shrinking liquidity through a bunch of different measures. And that's exactly the point where we are now in markets. So in this video, I'm going to explain to you why we're at this point and what it means for markets going forward. So far, the Fed has been loud and clear that they're real happy with the economy and that they want to continue their quantitative tightening and their rate hikes. But don't worry, this doesn't mean that a recession or bear market is right around the corner. We still got a good 12 to 18 months more left in this bull. But what it does mean is that you can't expect the Fed to stop tightening as soon as we hit another patch of volatility. And you should definitely expect more volatility, especially in emerging markets. And that's because the Fed is going to start pulling a lot of dollars out of the global market. So less dollars in the world market is always bad for companies overseas. Because the US dollar is the reserve currency, a lot of these companies' debt is denominated in the dollar. So if dollars are getting pulled out of the market, they can't pay off their debt as easily and things become really difficult. Plus, less dollars means a stronger dollar, which means they get screwed on the exchange rate, which again makes it tough to operate. Now, there's two main reasons why the Fed is tightening up. The first reason is after all that QE and all that liquidity they were pumping into the system by buying up those treasuries, well, now they've got a huge inflated balance sheet and they need to take care of that. And that means selling those treasuries back into the market. Now, the second reason the Fed is tightening up is to fund all the tax cuts we've gotten. So they're actually issuing new treasuries, which surprises me because were the tax cuts really that much? I barely got anything. Did you? So when you put all this together, this is an extra $2 trillion worth of treasuries that the market has to absorb. And these dollars got to come from somewhere, and so far they've been coming from the EM debt market. So all those companies overseas keep losing their funding. And then the fact that the Fed keeps raising interest rates is pulling even more dollars over here because money wants to go to where it's treated best. So with all this money flooding into the US, it actually supports our plays in all the big momentum names. So really at this point, the Fed only hates you if you're trying to invest in emerging markets. It pays to be US centric right now. And of course, we're gonna have more videos discussing what investments we're making in the US. So if you wanna see those, make sure you subscribe to this channel and hit that bell for notifications when those new videos are released. So subscribe and I'll talk to you soon. Stay fallible out there. Bye.